Can everyone hear me properly? Just give me a thumbs up. Sounds good. Awesome. Welcome, David. Welcome, Tony. Great to have you guys here. Awesome. So, folks, I'll just repeat what I say every single time, and I'll jump straight into this. Hi, Hisham. So basically, whenever I'm looking here, I'm actually looking at my second laptop. So just to see your comments and everything. Hey, Thomas. And whenever I'm looking to my right, I'm actually looking at my water. And obviously I have all the notes, and I have plenty of notes for you guys today. So we have a lot to cover. I don't think it's going to take that long, to be very honest, but it's going to be exciting. And it's going to be fun. So, and I'll answer all questions as usual at the end. So feel free while we're going through the session to actually type your questions, and I'll read through them at the end of the session and answer each and every one of them. So don't mind if I don't stop or actually at any point in time just to respond to your question. I'm going to review them at the end in case I miss them throughout the session. Hey, Dwight, welcome. So before we start, obviously, thank you very much for joining. Hopefully these sessions have been beneficial for you folks. So for the first 3 sessions, obviously we cover a lot of material. We spoke about in the past trading psychology, how to focus on your trading strategy, how to control your emotions, how to make sure that you trade with your mind, not with your heart. And once again, these sessions are very much tailored towards day traders and swing traders. Day traders are ones that actually buy something on a certain day, and then swing traders are ones that actually trade a certain stock over a couple of days. So, and for one reason or another, for whether they want it to actually increase or they think that it's going to increase over the next couple of days, or they actually got into a position and they got stuck. So basically they will have to wait a couple more days before they actually can swing it. Once again, for long-term holders, these sessions could be beneficial for you from a trading charting perspective. So we've covered a lot of basic fundamentals like support lines, resistance lines. We've covered things like MACD, stochastic RSI, and what have you. So I cover a lot of technical stuff, so you can benefit from that. However, if you are a long-term holder, once again, charting does not really matter to you unless you want to understand what's going to happen over the next weeks or months. So that's why you would actually look at those charts. However, I personally cover only the hourly and the daily charts, as I always do, because of the fact that I am focused more on day trading and swing trading. Long-term holders don't matter so much because you are heavily invested in the company itself, and you believe hopefully you have done your due diligence and believe that this company will be increasing accordingly. Hi, welcome. Okay, so let's get going. So last week we discussed 3 topics. We could discuss Japanese candlesticks. We discussed MACD, moving average convergence divergence, and we've discussed the stochastic RSI. If you've missed that, there is a recording of that session, and you can find it on YouTube. It's session number 3. So a quick reminder: Japanese candlesticks. We'll just go through the basics in case someone hasn't got a chance to look at it. Let's take this candle, for example. We call this part the upper wick or the upper hollow. We call this right here the closing price. Since this is a bearish candle, this is the closing price right here. This is the open price, and this is the lower wick, okay, or lower hollow, okay. So, and of course, whatever we have in the middle is the body. So this is a body, this is a body, this is a body, and the rest are wicks, okay? We also discussed the MACD and the importance of MACD, especially for me. I use it a lot in my trading. I use it a lot when entering and exiting stochastic RSI and MACD. You'll see me reviewing the 3 moving averages, the 5-hour moving average, the 50-hour moving average, and the 200-hour moving average, along with the 5-day, 50, and 200-day moving average, along with the stochastic RSI and the MACD. We spoke about the fact that MACD, when we need to monitor the histograms quite closely and look at the color of the histograms. The dark green indicates that we're moving into a bullish pattern. The light green indicates that the pattern is actually decreasing from a bullish nature, and we need to pay attention in case it moves to a bearish nature. We also discussed the coloring right here. When it's dark red, that means we're going really bearish, okay? And once we start seeing the light pink, then this gives us hope that this is actually moving again into the bullish direction. Once again, that's for a bullish mindset. Of course, for a bear mindset, they want to see more of this dark red and less of the green. So it really depends on which strategy you are actually pursuing accordingly. Finally, we also discussed the stochastic RSI. We discussed the importance of the blue line versus the signal. And we've discussed that anything over the 80 is called overbought. Anything under the 20 is called oversold. And we've also discussed the pattern and the way the blue line is moving. We've discussed that when the blue line is right here and moving horizontally, supported with a bullish MACD, we know that the price will continue to increase. We also said the opposite. When we see a horizontal line moving right here in the oversold area, supported by a bearish MACD which has not initiated the reversal, that is a bearish pattern, and most likely the price will continue to decrease. Okay, so we've discussed the importance of actually watching the signal closely, and when it crosses over this the blue line crosses over the signal, and when the reversal is initiated, and so forth. Once again, a lot of material. In case you missed that, please head to the session number 3 and review it accordingly. Okay, excellent. So this week we have a lot to discuss, but the focus that we're going to think about for this week, or the topic that we will be discussing this week, is market environment. And then we're going to talk about trading breakouts and fakeouts. There's a lot of theory here, but hopefully as we go through the theory, I'll demonstrate to you on the chart. But feel free to take notes, because I'm going to share a lot of theory here, and I'm going to tell you exactly what I mean by market environment and what I mean by trading breakouts and fakeouts as we move along. Okay, so let's start with market environment. And whenever I'm looking here, I'm looking actually at my notes, so just letting you know. So market environment is extremely important for any trader. So you need to actually appreciate whether the market is what we call trending or ranging. And we've actually discussed that in one of our previous sessions. I believe it was session number 2 or 1. I don't recall, but when we're talking about a trending market, is a market that is actually moving in the upward direction or the downward direction. So trending up and trending down. Just like here on the chart, it's trending up, and right here it's trending down. Okay, we also discussed in the past that there is something called ranging, or as we referred to it as consolidation. That's when the price is actually moving within a certain range. Okay, so all of your understanding of these market environment will allow you to use the right strategy in order to move forward with your trade accordingly. Okay, so I've also discussed in the past that you need a trading plan. You need to know when to enter and when you want to exit. You do not follow the hype blindly. You need to know when you want to enter into a position and when do you want to exit from a position. Okay, not having a trading plan is never recommended and will most likely end up badly. Okay, especially if you end up holding a bag because you followed a hype. Yes, you might have gained 100-200%, but if you don't exit in the right time, you might end up actually losing all this profit, returning back to where you started, and even worse, it could decrease below your price, and then you are stuck with a bag. So always have a trading plan. And as we go through these lectures, hopefully by knowing all the charting, knowing all the tools that I'm using, and I'm passing it along here, you'll be able to decide accordingly. So there are two types of strategies when we're looking at a market environment. There's a trend-based strategy, obviously, and then there's a range-based strategy, okay, depending on which trade you're going to pursue, whether it's a trend up, trend down, or a range. So the next point I've already explained. There are three scenarios, as I mentioned just earlier and right now. There's a trend up, trend down, ranging, or consolidation, or actually they refer to it somewhere. I'm trying to find this. Chipping away. Anyways, I'll get to that in a bit. So those are the three that we will be discussing today. Okay, further. Now, trending. So we'll talk about the trending market and what does that actually mean in more detail. A trending market is actually a market is moving generally in one direction, either up or down. Now, you've probably heard of these terminologies in the past, or you've read them somewhere. When we're talking about an uptrend, we are looking for higher highs and higher lows. Okay, higher highs right here. Let's see, this is a higher high than this. This is a higher high than this. This is a higher high than this. Higher high than this. And when we say higher lows, this is the low of the candle. This is a higher low than this low. This is a higher low than this low. This is a higher low than this low, and so forth. So you have a higher highs and higher lows. When you're actually looking at downtrend, then you have lower highs and lower lows. Lower highs. So this is the high right here. And then this high is lower than this. Then this high is lower than that. This high is lower than that. So we have lower highs and lower lows. Again, you look at the bottom of the candle. This is a low, and this low is lower than this low, and this low is lower than this low, and this low is lower than this low. So there's a downtrend. There's a lower highs and lower lows. Again, if I'm going too fast, please feel free to take notes and remind me of wherever I was going too fast, and I'll repeat the information at the end of the session. Okay, so remember those, and you probably heard of them. Now you appreciate what they mean even further if you haven't known so far. So when we're looking at a trending market, it's very important that you look at the liquidity, okay? And the liquidity, I personally look at it is in terms of how much volume is on the market. And this is why you'll notice that sometimes I receive many requests on Twitter asking me to review certain stocks. However, once I look at that stock, I notice that there isn't enough volume in it. And by volume, I don't mean like millions of stocks being sold or bought, it really is dependent on the price of the stock. So if we're talking about a stock that is 0.0002 and is trading 200 million, that's nothing. Again, that we're talking about a couple of $1,000s only. So that's why I refuse to actually review them at that time, because I don't want you guys to go into something either heavy or small and then end up stuck in that position because there's no liquidity. So you might be able to buy the shares. The problem is going to happen when you actually want to sell them. Who are you going to sell them to? Now, there's an exception. Of course, the volume might not be there just yet. The volume might come with the news, might come with a catalyst, or what have you. I appreciate that. And it might be a great entry position. However, personally speaking, I'd rather get into a position once the volume, dollar-wise, kicks in, rather than getting into a position and getting stuck in it, okay? I'd rather buy something, and I've mentioned this in the past, at a higher price and pay for it a premium than to get it at a cheaper price when there's absolutely no interest in that stock. So just keep that in mind. Everyone has their own strategy. My own strategy, if it's not liquid enough, if there's not enough money trading in this, I will not be getting in. And what do I mean by enough money? In the OTC market, typically, and that's me, Raji trading, okay? In the OTC market, I need to see at least $250,000 worth of money being traded, okay? And how do you calculate that once again? You take the number of shares or stocks that have been traded and multiply it by the average price for trading for that day. If it doesn't give me $250,000, the stock doesn't interest me whatsoever, okay? When I look at it from a NASDAQ New York Stock Exchange perspective, I expect the stock to have at least $1 million in worth of volume in there. If it doesn't, then I'm probably not going to get in, because I want to get in and out quickly, okay? Unless I'm obviously investing heavily and for long term. So that it really doesn't matter again. So make sure that you pay close attention to the volume. The volume drives the price, okay? And the volume needs to be used to your advantage. Do not enter into something, my recommendation, do not enter into something if it's not liquid enough, unless you're willing to be stuck there or wait until the volume actually comes in later on. That would be up to you. Now, how do we know if something is actually trending? So, there is an indicator on TradingView called the Average Directional Index Indicator, or ADX. So, in fact, if you go on FX right here and you type ADX, you'll notice Average Directional Index. If you click on that, it will actually, I already have it right here. It will show you this nice chart right here. Okay, so this is actually a very good way to appreciate whether there's enough volume indicator or what have you, or there's enough trend in this stock or not. Now, as you note, there is a number right here, and this number is very important. When the number is actually over 25, then the market is actually trending, okay? So there is interest. The higher the number, the more trending it is. And as we will discuss later on, the lower the number, if it's below 25, then it is actually not trending. It might be ranging, and the lower the value, the less trend there is on the market. So again, you want something that looks a value that is over 25. The higher, the better. Okay, we're done with first page. So now there are a couple of drawbacks to ADX, the average directional index. And the first drawback is the fact that it is a lagging indicator. Okay? What do I mean by lagging indicator? It means that it does not actually predict what's going to happen in the future. Okay? Which is honestly not a big deal to me personally, because there isn't anything that predicts what's going to happen in the future. It is only you that actually predicts what could happen based on your on reading the chart. Okay, so the value right here gives you the actual average directional index at this very moment, right here at this very moment, and so forth. Okay, it's not going to tell you what's going to happen later on. However, if something is actually trending right here, you definitely know that there isn't much happening. Notice right here, the moment it starts trending, notice the price movement. So I want you, while I'm walking you down here, to look at the price movement. Notice right here, it's ranging. All of this is ranging. Now, notice when I start moving up right here, oh, the price is actually increasing. Now we're going down. Again, ranging, and boom, this starts moving up, and all of a sudden we're trending, meaning the volume has been coming in, okay? And there's more momentum, okay? We lose momentum, it fades away, the volume. Guess what happens? The price actually starts decreasing, and so forth. So I think you get the point. So it's first drawback, again, lagging indicator. Does not predict the future, does not anticipate what's going to happen in the future. That's the first thing. The second thing, it's a non-directional indicator. Okay, what does that mean? It means that the points across the chart are always positive. Okay, so you don't actually know whether it is actually moving up or down when it's trending. Okay, the more, it could be actually trending up, just like right here, and it's actually decreasing in price. So you need to assess accordingly. However, I'll be discussing with you shortly how you can actually take advantage of that. When you're moving up in that direction, notice you reach to a peak. Once this peak, you start descending, you know that the price is actually going to start descending as well. Okay? Similarly, if you were actually moving in a downtrend, the trend is probably going to peak, and then once it peaks, you know that you might be going up all over again. So I don't want you to misinterpret this chart as if when we're going up, it's always going to go up. No, this only means that the trend is actually is increasing in value. I don't want to say moving up, so as people not to confuse people. The trend is increasing, the volume is increasing, and it's an indication of high selling or high buying. Okay, the moment it decreases, that means it's fading away, and the volume is going away, and we're probably going to get into a ranging period, a consolidation period accordingly. Hopefully so far so good. Now, another way to actually detect that a trending market is using moving averages. Now, I personally don't use that, but it's also used by several folks. Is to use, see how I have here 5, 50, and 200. Some people actually use the moving averages of 7, 20, and 65. Okay, now 7 means 7 hours, 20 means 20 hours, and 65 means 65 hours, since we're looking at an hourly chart. If it was a daily chart, it would be 7 days, 20 days and 65 days. Now, how do you know that it's trending upwards? When the 7-day moving average is on top of the 20-day moving average, and the 20-day moving average is on top of the 65-day moving average. Okay? So one is on top of the other, beginning from the small to the largest. Period. When the smallest period is on top of the second smallest, and the second smallest is on top of the third smallest, you're in a trending up market. When the 7 is below the 20-hour or 20-day, and the 20 is below the 65, then you are trending downward. Okay? So if you're interested in using moving averages, you can also use those 7, 20, and 65. I personally like the ADX, so you might want to add that to your chart. And it's actually it's quite straightforward. That's why I prefer to go with it accordingly. Okay? So hopefully that is clear. The volume and the price benchmarks are a nice guideline. Exactly, Thomas. Okay, excellent. So that's the trend market. Let's move on to the ranging market. So the ranging market, as I mentioned earlier, is when the price is actually moving, just like the name, within a range. Okay, let's look at here. Notice, for example, DGTW right here, Digital Town, is actually moving through a range right here. There's and the top part, the high price, is actually the resistance, and the lower side is the support. Yeah, let me expand it a bit more, just in case it's too, yes, perfect, just in case it's too small. Okay, so it's actually ranging between, let's look at this, it's ranging between 0.0001 and it's and 0.0004. Yes, of course, I understand totally that this is a huge range and you might be losing a lot of money and what have you. But the thing is, it is consolidating. And that's why I'm saying, once you detect that range, you can actually play the chart very well. Because you know it's going to probably decrease here, and then it's going to return back here, hit a resistance, and come back down, which is exactly what we're seeing here. So you can actually play the chart and start playing, start buying at maybe 2, selling at 3, buying at 2, selling at 3. Yeah, and remember, 2 to 3 is 33%. So it's a lot of money right there, until you actually come to this point, and then, as the smart trader that you are, you see a golden cross. Wow, 50-hour moving average has crossed over 200-hour moving average. And because you're a smart trader, you know that this is a very bullish indicator, and then you jump and hold because you know that the price is going to go up. Okay? And then you play the chart accordingly. But I'm not going to get into the trending because we've already spoken about the trending. But that's how you play the chart when you're talking about arranging. You have a range and you trade within that range until you get a signal that this range is going to be broken. Okay. So as I mentioned earlier, some people refer to this as a choppy market because it's chopping up and down. Okay. Some people refer to it as, there's different references. Oh yeah. Some people say horizontal, and obviously there's consolidation. That's a very common terminology when when the price is ranging all across. It's actually consolidating, and in fact, consolidation is fantastic because it's giving the stock more energy and more power to go either up or down. That's what you need to detect accordingly. Okay, now, as I mentioned earlier, ADX is great to identify that. The lower the ADX is, the likelihood that you're actually going to be ranging. And the lower the number, the lower the trend accordingly. So remember, ADX over 25 is for trending market. ADX below 25 is for a ranging market. Okay? So what else? Okay, the lower the trend, we've covered this. Okay, so knowing the trend will allow you to play the market since you know your entry and your exit, which now actually, if you think about it, makes complete sense, because you know that you're gonna buy on support, sell at resistance if it's ranging. Once you get into the trending market, you try, it doesn't work all the time, but you try to buy at low, sell at high. And as I mentioned in previous training sessions, no one gets the lowest price, okay? In fact, I'm sure you can relate. I've never bought a stock that took off after I buy it. In fact, it happens. I'm not saying it doesn't happen. It happens, but most of the time, it seems like the stock market knows that you're going to buy, and it decreases right away after that. And then it picks up afterwards because the chart is telling you it's going to move up. But for some reason, it likes teasing you, and you buy, and then it decreases right away for a slight bit of time. So I'm sure you can relate to that. And the same thing when you're actually trying to sell. It's funny, you sell and then it skyrockets. How many times have that happened to all of us? Okay, so that's why don't take it to heart. I think there's a superpower beyond all of us that is actually trying to just, I want to use the right terminology here, just tries to get on our nerves whenever it's going low or whenever it's going high. So yeah, you're not the only one, Tony. Rest assured of that. I think it happens to everyone over here. So I'm glad. I think by the comments I can see a lot of people relating. So yeah, this is very common. It's fine. But again, once you learn more the chart, once you understand the trends, once you can appreciate those, you'll become more smarter in this approach. You'll know exactly when to play it right. Hey, if it decreases 5-10%, whatever, as long as you know that the price is actually going to increase because you know your chart, you know everything, then you're fine. Don't worry about those 5-10%, especially if you're playing in OTC. You guys should be immune to that by now. If you were in New York Stock Exchange or NASDAQ, well, there's a different story. Although the market right now is fluctuating majorly. Trust the chart. Yes, sir. Trust the chart. So that's pretty much what is a ranging market. So now we're going to talk about trend retracement and trend reversal. I'm talking a lot. Okay, so what is a retracement and what is a reversal? Big difference between the two, by the way. A retracement is actually a decrease in the price for a very short period of time. Yet the trend continues, whether it's up or down. So it might decrease in price and then continue going up. Just look at right here. It's actually moving up. Oh, it decreased a little bit right here. Then that's a retracement. Then it moves up. Oh, retraces again. Moves up, retraces again, slightly. Moves up and retraces again. Boom. Similarly, right here on a downtrend, it's decreasing in price. Boom. That's a bullish retracement, and then it continues. Bullish retracement continues. Bullish retracement. Boom, and continues the downtrend. So that's a retracement. There's a big difference between a retracement and a reversal, as I mentioned. A reversal is a complete different change in the trend. So when you're actually ranging, just like you're happening here, and it breaks out, that's actually you're actually getting out of it. That's also called a breakout, but I'll discuss that later. Right here, you're ranging, and then that happened. When you're moving upwards, okay, and then it stops moving upward even further because the buyers got exhausted, and then it moves down completely right that's a reversal because it did not actually continue. That in fact, one thing that is interesting, and this is something we'll discuss in later lessons, if you notice, folks, there is a W here. This is normally a bullish pattern, the W. However, right here, it went down. And that's why nothing is always 100%. This is a great thing that you need to keep in mind. So all of this charting, you need to monitor it closely. It heavily depends on stochastic RSI and MACD. It works very much for me. In fact, Jerry is mentioned a comment earlier. He was looking at the 7-hour moving average or the 7-day moving average. I don't recall, but he's right. Every single trader will find ultimately the combination that works for them. Okay, so I'm using 550, 200. Doesn't mean that you have to use those. If you can actually find different moving averages that work perfectly for you, go ahead. The logic is still the same. The concept is still the same. You're just using different metrics. You're using different tools that work for you. As I mentioned in the past, some people prefer not the simple moving averages that I use, the exponential moving average, EMAs. Every trader is different, okay? So once you find your own secret sauce, stick with that, because that's what's going to make you successful accordingly. Okay, so the switches. So again, to summarize, the reversal is actually when the uptrend switches to downtrend, and the or the downtrend switches to an uptrend. Okay, so this is called breakout. What we spoke here, when the consolidation is there and then it breaks out of consolidation, and we'll get to that later on. So what do you actually do, or what options do you have when a retracement actually takes place? So there are 3 options. The first one is actually you hold on to your stock. So right here, it went up and then it retraced. You can either hold on to your stock, okay, and there is a risk, okay, to you actually holding on to your stock in case the retracement ends up being a reversal. Okay, so if it ends up being a reversal, just like it did right here, you'll probably lose a lot of profits. Okay, you're still good if you came in here. However, if you came in here and then it actually reversed just like it did right here, you might actually lose all your profits. And if it comes here, you're actually in the negative. So it really depends where you come in. But if you came here, you probably still have made 60% profits, even if you sell right here, because I'm just basing it based on what I'm the shape of the chart. So if this is all 1 and this retrace about a third, then you still have 66%. But again, if you came in here, then you're actually stuck. If you came in at 0.5 Fibonacci and it actually retraced, you might be ending up in the losses. So very important to note that. The second thing is second option is to close your position and then re-enter at a lower price, right? So how many times have you heard that someone buys at the bottom, okay, or near the bottom, and then it goes up because they know it actually going to retrace, let's say till here, because there's Fibonacci, okay? They sell right here and then they buy when it dips, okay? So you sell at a high point and then you buy at the dip, hoping that this dip will actually help you gain more profits as it continues with the trend. As long as the trend is continuing, then you're good. Okay. So that's what I mean by closing your position and re-entering once again. Now, the only drawback again with this is that if you close your position and re-enter once again, there's still a risk that once you re-enter, you might have misread it and it actually reverses. So you'll need to close your position completely or take losses and leave. Now, the last one is the last option that you can pursue is just close permanently. So you close your position once the retracement happens and decide that's it. You're not going to trade anymore. So I actually see it going up. I see it retracing a little bit. I close and get out with whatever profits I made. Now, the problem here, obvious one, is that if it continues, you've lost a lot. Okay? However, if it actually reverses, then you've saved yourself a lot of losses, actually, and you've kept some profits. So that's why a lot of people actually, and those who trade on TD Ameritrade or any other broker, that's why a lot of people use trailing stop. Okay? Trailing stop actually helps you manage your risks and save some of your profits accordingly. Okay? Done with 2 pages. We have one and a half. Okay, so identifying retracements, those are actually quite quick. How do we identify retracements? Remember, we've discussed this in the past. There's 2 ways. There's the Fibonacci way and there's the trend lines way. Okay? The Fibonacci, as I mentioned, you actually draw it from high, swing high, remember? To swing, swing low to swing high, okay? To the top of the highest candle. And then it gives you the different Fibonacci levels. Okay. Now, as I mentioned in the past, those Fibonacci levels are typically used by traders as a potential entry or exit points. Okay. As we can see here for DGTW, for example, we can see that the chart actually held quite nicely around the 0.618 Fibonacci level, 61.8%. It touched it a couple of times, not fully touched it because it's 1567, but this is actually 16, as you can see right there, and it bounced back, so it held quite nicely. So if you would have actually entered here at 16, you would have probably made a lot of money a couple of times. Okay, so typically with Fibonacci, 0.382, 0.5 and 0.618, as we can see here, are normally where price actually hangs around when it's a retracement. If it goes beyond this, it may be, so if it goes beyond 0.618 or it goes beyond 0.382, it may indicate a reversal. And note, I'm saying may because it might not be a reversal. There's nothing 100% with charting. It's all about reading as accurate as you can. You will not get it always right. Even the best people out there cannot get it always right. Okay? You try to minimize your risk accordingly. Okay? There's no hardcore science behind this. Well, there is, but you know what I mean. But once again, if it gets beyond the 0.382 and 0.618, you are probably heading towards a reversal. You may be going into a reversal accordingly. So the next one is the trend line. So the trend line, I've actually shared it before. Let me take BRTX as an example. Okay, so let me look at something right here. No, actually, I really do not want to take this chart because it irks me whenever I actually look at them. But yeah, I'll take GRST because they're the best at making you lose money. But anyways, that's beyond the point. So a trend line right here. This is what I mean by trend line. You draw a trend line. Right there. Oops. Can't even draw it properly. Yeah, right there. Okay. So once again, this is the trend line. The trend line, how do you draw it? By connecting several candles together. The highs of several candles. So don't make yourself don't trick yourself here and just create a line that fits your needs or makes you happy. Make sure that the candles are actually touching each other, and you need to have at least 3 candles touching each other, or else it's not a trend line. Okay, so it's very important that you're drawing the shape of the trend line correctly, because if you're not, then you're tricking yourself. You're accommodating what you want, not what the chart actually is doing. Okay, so there's a falling trend line. A reversal happens once it breaks through that trend line. And notice it broke through here and it continued upwards before it started to go down because it's GRST. But no, I'm going to keep on taking a stab at them. Anyways, until they reverse. So it broke the trend line right here. Is that a confirmation right here? No, it's not. Okay, you need to make sure that it actually breaks, as I always write in my tweets, comfortably. So this trend line, just like a moving average or like a support level, will always try to pull the price back because it doesn't want it to break. Okay, notice right here, it actually, if you look at this candle, actually it was trying to break, but the trend line pulled it back. In fact, here's a perfect example. Look at right here. If someone would have entered a position right here at this point, they might have lost a lot of money right here, unless they decided to hold. Okay, but this was a fake breakout. Okay, this was fake because the trend line pulled it back. It is actually the next candle that was the confirmation that we have a breakout or a reversal in the trend. Sorry, I keep mixing them up. The reversal in the trend happened on this candle. And how do we confirm that? Because the next candle actually closed above the trend line. The third candle closed above the trend line right here. So always wait for a confirmation before you get in. I've said that in the past. Do not just blindly get in just because you see a gleam of light that it actually broke. If it breaks, wait till it really breaks. Okay, that's why when I say when it passes a support level, do not just jump in right away, because the support can pull it back again. So always wait for a real confirmation before you actually go in. Okay, I want to change the chart just because I don't want to see this. Okay, cool. Next, what else do we have? Breakout. Okay, so that's trend lines. Trading breakouts and fakeouts. I actually covered it right now. Trading breakouts and fakeouts. Breakout, it happens. There's 2 types of breakouts. There's a continuation breakout and there's a reversal breakout. The continuation breakout is just like, for example, imagine this. Obviously, when we expand the chart, we'll notice that ENZC had previous highs. Okay, so this is not the perfect example right here, but oops, Okay, let me just expand this a bit more. Okay, so assume that we didn't have the other part of the chart, half of the chart, and you're reaching to a point that it has reached in the past. Actually, this is a perfect example right here. Notice at 0.042, ENZC was actually, if you recall, was coming all the way here and then retracing, going all the way here and retracing, going all the way here and retracing. That was happening on Friday before it actually broke out to 0.05. Okay, that's called a continuation breakout. Okay, and if it would have actually broke out to 0.043, in fact, if you remember Friday very well, it went to 0.043 and it kept on coming back. It kept on bouncing between 30, I believe 37, 38 to 43, and kept on going back and forth until it actually, at the end of the day, started breaking out completely. That's a continuation breakout. Always wait until you have a confirmed breakout. Do not just jump in on something because it actually increased by 1/100th of a cent or whatever it is. Okay, just be comfortable that it broke out by a couple of percentage before you actually jump in and ride the wave. Okay, so that's pretty much what I mean. What I mean when I say join in when it breaks out comfortably. Now, again, how do you actually spot a breakout? Once again, there's the trend line that I discussed just before, and then there is channels. So when you actually draw a channel right here, if you draw a line, let me just do it just like the name sounds. So you connect the dots. This is a very ugly channel, but anyways, right there, you connect several dots, and then okay. So you see how I try to be extremely accurate when I'm drawing a channel, because I want to make sure that the candles are actually all touching each other properly. I'm not letting my imagination run right here. Okay, so see, this is a channel because the price is actually moving, trending upwards. Here it broke out from the channel. Okay, and then it broke out once again. So that's another way of actually doing it. And you can draw a channel right here. There's a ranging channel, there's a downward channel, and etc. Okay, and then you have what we call a triangle. So observing a triangle, this is actually how you spot a breakout. There's an ascending triangle, and there's a descending triangle, and then there is a symmetrical one. So the ascending triangle normally has a resistance line on top, okay, and then you have the higher lows. Okay, so the triangle is actually, I don't have a pen. Okay, let me just try to draw it. So the triangle is actually moving that way. Okay, so this is the resistance, this is these are higher lows created. So this is actually a bullish triangle, okay, because it means that the bulls are actually trying to push hard upwards, and that's why we have the higher lows, and it breaks upwards. So once you observe that, that's a good indication that there's a breakout happening. Now the descending triangle, which looks completely opposite, you have support and you have lower highs. Okay, that means that there's a strong force by the bears and they're trying to drive it down, and it hits the support level and then it breaks downwards. Okay, the last type of triangle that we may have, and you probably have seen it, is a symmetrical triangle. So it doesn't have a support or a resistance. It looks like this, and then you have higher highs, higher lows and lower highs. However, the problem with this type of symmetrical triangle is that you don't know which direction it's going. Unfortunately, it might go up, it might go down. It's unlike the ascending or descending triangle, which tells you how it's going to break out accordingly. Okay, the symmetrical one, it could go either way. Another ways of confirming the breakout is by looking actually at the MACD. Okay, so remember when we discussed histograms in the previous lesson, you'll notice that I said when the blocks or the histograms are growing in size, that means it's becoming more bullish. Okay, same thing here. When the histogram is actually growing in size or getting bigger, the momentum is actually picking up and it might be breaking. So try to put everything that we've studied today or have shared today together. So when you have a high ADX along with a bigger histogram, along with a bullish stochastic RSI and a bullish MACD, you know that this is going to break out. So use that to your advantage. When the histograms are getting smaller, then the momentum is slowing down. It's fading out. Okay, and that's something to keep in mind. And once, obviously, once it starts fading out, you should expect a reversal accordingly. The other one is the stochastic RSI, as I mentioned in previous lessons, is when it's in overbought or oversold, and the shape of the stochastic RSI, as I discussed in the past, will also help you determine whether it's going to continue moving up and break out or not. Remember, I said when it's a horizontal line supported by a strong MACD, then it's probably going to move in the overbought area, then it's probably going to move up in price. When it's a horizontal line that is continuous in the oversold area supported by a bearish MACD, then it's going to probably decrease in price until a reversal happens. Okay, so that's pretty much it for today. I know I threw out a lot of information. I know that this might be heavy stuff, and this actually is the longest session that we've had so far. So now it's all for you folks. Please ask your questions and I'll get to it as much as I can. Okay. Did I do ADHC? No, Keeper, sorry, I'm not doing charts. I'm actually going through training in terms of the different charting, different ways of reading charts, different ways of identifying trends, and so forth. So it's not reviewing charts. I do reviewing of charts on a daily basis based on the requests that I get from followers. Okay, so then the next question, can you show the triangles on the current chart? Okay, so let's try to find. So, okay, let's see. trying to find one right here. It's not a strong triangle right here. I would have said right there, there's a resistance level and there's a small triangle here, and it broke out, but it's not really a strong triangle. Let me look at another chart if we have one. Solo. Actually, right here. Perfect. Okay. Got you one. Let me show you. And that's why you need to identify them. Right. Oops. Not this. Sorry. I need a horizontal line. So right here. Right here. And then right here. So if you notice the triangle right here. Boom. This is the support. This is, remember what we said, the lower highs. Guess what happened? This is a descending triangle. And guess what happened? Boom. Moved down in price. Because it's the sellers gaining more power. Okay? So that's a descending triangle. Hopefully that is enough as an example of Tony. But you do have to identify those once you see them. So that's pretty much an example. Okay, next question. Can you explain TTM squeeze again? So I haven't explained TTM squeeze. I'll be doing it in a separate session. And I'll be more than happy to cover it later on. Suraj, do gaps always have to be filled? You know what? This is a great question. Okay, so there isn't a fixed response on that, Suraj. A lot of people have different opinions. I personally think that they do have to. Ultimately, they will try to get filled, okay, but it is not. It doesn't have to be exactly at that price. It can get closer. So there is a thought that it actually needs to come down to the lowest level to the last candle. So if a candle actually closed at say $2 on the previous day, and then on the next day it actually opened at $5, okay. There is a thought out there that the $5 needs to go back to the $2 before it can actually continue. I don't believe in that. I think there might be a candle before it that was actually at 210 or 215. That could close the gap for me, okay? It doesn't have to actually touch $2. However, there are people who strongly believe that it needs to go back all the way to $2. I personally do not believe in that. I don't believe it always have to close the gap at all times. However, if something actually in the pre-market increases heavily, you are most likely going to revisit the previous prices. Not immediately, but in the future. Or it could actually be immediately. We've seen that example on ENZC. It opened, I actually forget, it opened I think 36 or 37, and it pulled back again. So did it fill the gap completely before it went forward? No, it didn't actually. If you look at the candles, it filled the previous candles, but not the last candle. So different schools of thoughts, but I personally think it has to fill some of the gap, but not the whole gap. Hopefully that answers your question, Suraj, to as much as possible. Okay, any other questions, folks? Or are we good to go? So I'm assuming there are no more questions. If you actually have any questions, pleasure, folks. You know how to get to me. You know my Twitter. Feel free to reach out. I'm always available and happy to support you guys. But I'm extremely proud of a lot of you because I'm seeing a lot of you who are actually implementing this. And I'm seeing it through the comments that are being made on Twitter. So please continue to learn more. Please continue to read on your own. Expand on this, strengthen yourself even further. But I'm definitely proud of what I'm seeing already because I'm seeing a lot of people who are actually improving their chart reading and they're trading accordingly. Nothing makes me more happy than someone actually telling me or commenting on a tweet when I say it has hit fib 0.618 or 0.5 and it bounced off and tells me I love this because I actually learned it yesterday with you. Fantastic. Keep learning. The moment that you should be concerned is when you stop learning. So please keep learning. Keep learning from your mistakes. Don't be hard on yourself. But again, as I said in the past, you're only allowed 2 mistakes. The third time you make the same mistake, you have no one to blame but yourself. With that, I wish you guys all the best. Let's kill it on Monday and next week, and let's get more wins. Have a great night. Take care, guys.